Understanding the relationship between expectations and results is crucial, especially in investing. If you don't have any expectations as far as the results, you'll never be disappointed. But if you have unrealistic expectations, you will be disappointed. If you have a portfolio and it is invested in the market and you expect it to never go negative, is that realistic? We need to have our expectations lining up with reality, with the results that the portfolio can accomplish. And then we will have peace of mind. And that's what we're going to talk about, lining our expectations with the results. Specifically, the objectives of this session are: 1, to identify current investment expectations. Are your investment expectations based in reality? To clarify common investor illusions about investing is number 2. What are the common illusions that people hear and see about investing? And have you picked those up? 3rd, to understand the relationship between expectation and results. What are you expecting, and does it line up with those results? 4th, we're going to examine the breakdowns that lead to investor disappointment. The breakdown comes between the misalignment of expectations and results. Then we're going to, for number 5, we're going to explore reality fixed scenarios that lead to reachable expectations. We want to be able to get to where we expect to be. You're going to see a checklist. What I would like you to do is take the pen that's there and mark as I go through these. Does long term mean 5 to 10 years? Yes or no, true or false? Okay? Everybody mark one. True is the first column, false is the second. There. All right. Do you think that's true or false? Investments that have performed well in the past, will they continue to do well in the future? Do I believe that that's true, or do I believe that that's false? When it comes to investing, I expect to make frequent changes to my portfolio based on current market activity. Is that true or false? Which one's your expectation? When it comes to investing, I expect to get better returns than my family, friends, or colleagues. Am I going to get better returns than my family, friends, or colleagues? When it comes to investing, I expect that logic and rational thought will be the determining factor in my personal investing decisions. Okay? I'm going to take a motion on it, right? True or false? When it comes to investing, I expect that the information and advice I see on TV, newspaper, and the internet will help me to make good investing decisions. When it comes to investing, I expect to consistently beat market rates of return. True or false? When it comes to investing, I expect my financial professional to effectively predict economic and market changes and have all the answers.
Isn't that what you're there for?
When it comes to investing, I expect more risk will always mean more return. When it comes to investing, I expect to worry and fret about the state of my portfolio, especially when the market drops or my returns are low. Now, if you would, take a quick add of all the ones that you marked as true. Put down total true in the box there at the bottom. Okay. Did anybody mark 0 true? 0. Really? Okay. 2, that's good. You're a realistic investor. Okay.
I thought about that a lot of years ago.
If you had 1 to 5 truths, then your investing expectations may need some modification in order to experience long-term peace of mind about your financial future. Now, if you scored 6 to 10, okay, you need a lot of help. Your expectations.
You're in the right place.
Yeah, you're in the right place. Your expectations about investing are not based in reality and likely to be a source of ongoing stress and disappointment. Okay. So now we're going to take a look at some investor illusions. First one that we're going to look at is the crystal ball illusion. Everyone knows that crystal ball is used to look into the future. There are 3 commonly espoused methods of investing that are equivalent to gazing into a crystal ball: stock picking, market timing, and track record investing. The other illusion is that there's a free lunch. And that's that investors continue to believe that if they look long enough, hard enough, and in the right places, they'll discover a way to get massive returns on their investments without taking any real risk. This is what we technically call a free lunch. Okay?
Gosh, I'm learning a lot.
Expectation and results. The expectation in achieving a market rate of return. We've got 3 states of mind. Okay, the first one is we're going to exceed the expectation. Euphoria, overjoyed, and thrilled. You're here tonight. You may have had an expectation. Our goal is to exceed that expectation tonight for you. The other alternative is to match the expectation. There you have peace of mind, some satisfaction, and contentment. And the third choice is an unmet expectation, where you have worry, concern, and disappointment. When we exceed expectation, we've got a better result. We beat the market rate of return. When we match the expectation, our actual result matched the market rates of return, the market being our benchmark. If we have unmet expectations, that means that our portfolio underperformed market rates of return. And a lot of times this can happen when we're buying and selling and changing the portfolio. Let's take a look at some investment reality. Now, some of this I'm going to go through fairly quickly. We're going to be looking at reality breakdowns. The first one we're going to look at is hindsight bias. I'm going to go to false patterning, emotional-based decisions, investor pornography. That was coined by Jane Quinn Bryant years ago. Fifth one is overconfidence, and the sixth one is necessary lies. Okay? So let's take a look at the first one, hindsight bias. And you know, hindsight bias is a tendency to believe that we knew all the time what was going to happen. Okay? Miami Dolphins player.
Can I tell this real quick? I went to the Miami Dolphins game on Sunday because I'm a big Tebow fan, and nothing happened the first 3 quarters. It was miserable. The Dolphin fans were just... Anyways, we left the game in the 4th quarter, and we get a text that they're in overtime, and I'm like, there's no way. And run home, turn on the TV, and watch the ending, and the Broncos won. And I missed it. I missed it. So, yeah, now, and my daughter, I'm like, telling her, you know, if I would have told you to stay, you wouldn't have wanted to stay. She's like, no, I would have. Hindsight, yes, now knowing that we were going to miss it, we would have stayed.
Miami moved going along 4 or 5 games, which are kind of realizing that part. Okay. Monday morning quarterbacks. Okay. Hindsight bias facts. If you had really known what was going to happen, you would have taken different decisions. All right? If you knew what was going to happen with a particular stock or a particular mutual fund, what would you do? You'd take all your money and put it in there. And so would your broker. If your broker knew what to do, you would put all your money, he or she would put all their money in that mutual fund or that stock. Okay. Fidelity has 1,100 mutual funds. Why? They have no clue which one's going to do well. But out of 1,100, they know that some will do well. Because if you look at hindsight bias facts, between 1977 and 1989, Fidelity Magellan, have any of you heard of Fidelity Magellan? It's one of the best performing mutual funds that had been around. It got higher returns than the S&P for 11 of 13 years. If we compare these statistics to the random flip of a coin, we find there is only a 1% chance of observing 11 or more heads in 13 flips of a coin. Using this analogy, it seems as if Peter Lynch, who was the manager of the fund during this period, was clearly demonstrating skill versus random luck. I mean, he must have been great, knew which companies to buy and sell and what have you. However, such thinking is one pitfall of hindsight bias. It is easy enough to look back from 1989 and see that Magellan was the big winner.